Okay, listen up. Something huge just snapped right in the heart of London's silver market, and you know what? Almost nobody is talking about it.
Yeah, it's not just like price noise. We're hearing the sound of the whole financial system cracking, a deep structural failure inside the LBMA, the world's biggest silver hub.
And it's not just London, right? On the U.S. side, crucial liquidity is just vanishing.
It really is. We've been digging into Rafi Faber's latest analysis, and he's showing how the next Fed reversal, which feels inevitable, could kick off the biggest precious metals rally we've ever seen, like the real endgame.
So that's what we're doing now. We're unpacking these structural failures Faber's identified. We'll get into his monetary timeline, this idea of a global perpetual dollar short squeeze, and why the physical silver market is setting up major red flags about credit breaking down right now.
Faber's work really maps out this final stage. So if you want to get ahead of this, if you want to understand these signals and know when the metal finally snaps, you need to hit subscribe to CredEdge. Seriously, turn on those notifications now.
All right, let's start with that timeline, because it feels off. Gold and silver have already jumped massively, right?
Yeah.
But Faber insists we're not in the final sprint yet. How does that work? Why is this rally, premature in his view?
Well, it comes down to the Fed, the big money printing. It hasn't officially started again. Faber's whole framework depends on watching what the Fed does, their actual behavior.
Not just their talk.
Exactly. We need to look at the mechanics. What are they doing right now versus what they do when they hit the panic button?
And what are the facts telling us?
Yeah.
What aren't they doing?
Right. That's the key. What's not happening? Okay, quantitative tightening, QT. They slowed it down, sure, but they haven't stopped it. They're still shrinking their balance sheet, still pulling liquidity out, even if it's slower.
So draining the system.
Still draining. And crucially, interest rates aren't back at zero. That's the big panic signal. And they definitely haven't started net buying bonds again. That's the real QE restart.
Okay, so gold and silver taking off like this, before the Fed is forced to unleash that next massive wave of cash, that suggests the system underneath is already incredibly stressed, like way more than it should be at this stage.
That's exactly Faber's point. He sees this early surge as proof the system is fundamentally broken. It shouldn't be happening yet. He keeps stressing until the Fed absolutely has to pivot, slash rates to zero, print exponentially more than even during COVID. We're just watching the preliminary tremors. We need that huge reinflation event for the final sprint.
Okay, this is where Faber's analysis gets really, really interesting. He talks about the entire world being stuck in a perpetual dollar short squeeze. Yeah. We hear short squeeze with stocks, but what does that mean on a global money scale for the dollar, for debt?
It's leverage gone completely out of control. The simple, kind of scary truth is there's just way more debt out there denominated in dollars than there are actual dollars to pay it back.
Wow.
The whole world is structurally short the dollar. Everyone owes more dollars than they actually have or can easily get.
So when things go south, when defaults start, it's an instant global panic for dollars.
Exactly. When the music stops, like Faber says, and defaults kick off, everybody, foreign banks, companies, hedge funds, they all need dollars immediately to service that debt. It creates this massive, sudden, desperate scramble for greenbacks. That's the squeeze.
And we saw this in 2020, right? During that squeeze, everything gets sold off to get cash, even gold and silver.
That's the prediction. It's that painful washout phase before the final revaluation. We saw it when COVID hit. Metals sell off too, temporarily, because people just need cash now. Gold dropped to, what, $1,450?
Yeah, and the miners got absolutely hammered.
Oh, clobbered. Down 20, 30, 40% in days.
But hang on, $1,450 again.
Yeah.
With all the inflation since 2020, all the new debt?
Yeah.
Doesn't that seem, I don't know, way too low? Almost impossible for a temporary bottom now?
Well, that's the sheer power of the leverage unwind Faber talks about. The squeeze is so violent, the need for dollars so intense that assets get dumped regardless of fundamental value. They just need something liquid. The key difference he points out is that gold and silver will sell off less, significantly less than everything else. But yeah, that temporary low, whenever it hits, marks that peak pain point, the moment of maximum liquidation.
So for you listening, the message here is patience. You wait for that sharp drop, that liquidation event, then the Fed pivot, the big inflation phase, to confirm the final sprint is on. Until then, stay balanced. Stay ready.
Absolutely. The pressure's building, no doubt, but the main catalyst hasn't fired yet.
Okay, let's shift now to something happening right now. A structural failure in the physical market. Not theory, but like the actual supply chain. What's this evidence from the London Bullion Market Association, the LBMA, that signals credit is collapsing?
Right, the LBMA. It's the world's biggest clearinghouse for physical silver. And Faber's pointing to signs that their vault system seems to be, well, running out of physical metal to back all the paper claims against it. That's a huge structural break.
How do we actually see that? What's the data point?
Well, the evidence is coming from the ETF vaults in London, specifically funds like SLV. They seem to be struggling to actually get their hands on enough physical silver bars to back the shares people are buying.
So paper's being created, but the physical backing is lagging.
Exactly. New York vaults have been kind of stagnant, but London is the global hub. That's where the danger is, because the paper promises might be outrunning the physical reality.
And this isn't just a supply issue, right? There's a historical signal here.
Oh, a very clear one. Faber highlights this repeatedly. Historically, when silver suddenly and dramatically outperforms gold-like, goes into a frenzy, it's a massive signal that credit is breaking down.
Why silver specifically?
Think of it as the people's money. When faith in paper evaporates entirely, people rush to silver. We saw this pattern emerge really strongly in 1918, 1968, 1980, and again in 2011. It's when trust in the system fails.
That's a really consistent pattern. People ditch paper promises for real metal.
Precisely. And you can track this with the gold to silver ratio. You know, how many ounces of silver by 1 ounce of gold? That ratio has already dropped quite a bit, from over 107 down to around 80 recently.
That's a big move. But 80.1 still sounds historically high for silver, right? Very cheap compared to gold. What does Faber see happening in the final reset?
He predicts an absolute crash in that ratio. He thinks during the final monetary reset, it plummets all the way down to 15.1.
Wait, 15 to 1? That's the old U.S. bimetallic standard level. Historically, he's basically saying silver's monetary role gets fully restored relative to gold.
That's the implication, a complete re-anchoring of value. It means the current silver outperformance. That's barely a warm-up compared to the explosion he expects.
Wow. Okay, so 15.1 implies a systemic credit failure, unlike anything we've seen in modern times.
That's the scale he's talking about. If you're finding this breakdown valuable, by the way, and you want clear analysis on these structural shifts as they happen, make sure you subscribe to CredEdge. It's crucial to stay informed right now.
Okay, so connecting that London physical squeeze to the bigger picture, Faber's clear the problems aren't just in London. The whole U.S. monetary system is running dry. What's happening with the Fed and the critical repo market?
Yeah, we've got a ticking liquidity time bomb over here, too. Remember all that extra cash parked at the Fed and reverse repos, the RRP?
Yeah, the buffer.
That buffer is gone, basically zero now, a few billion left maybe, which is nothing in the grand scheme of things.
And meanwhile, QT, quantitative tightening, is still happening.
Yeah.
So what's that doing to the system's plumbing?
It's been draining bank reserves directly, and those reserves, that's the essential lubricant, the grease for the repo market. That's where banks lend to each other overnight. It's a massive market, over $3 trillion traded every night.
Okay.
Here's the crunch. Total bank reserves have now dipped below $3 trillion. They're around $2.988 trillion and probably falling further because of how government spending works.
So more money is trying to trade hands every night than there are reserves to facilitate it. That sounds like a recipe for a jam. Are we seeing signs of stress already?
We are. Big warning signs. Look at the SOFR rate, the official repo rate. It keeps wobbling, jumping several basis points in a single day sometimes. That screams tightness. It shouldn't be doing that in a healthy system.
And if the SOFR wobbling is the warning light, is there proof some banks are already in trouble?
Yeah, look at the standing repo facility, the SRF. That's the Fed's emergency window for banks low on cash. It's being used now, not huge amounts, maybe a few billion a night, but the fact it's being used at all tells you some banks are already out of reserves. They need emergency overnight funds.
That is literally the sound of the system seizing up.
It really is.
Okay, let's pull it all together then. You've got the physical silver shortage brewing in London and this dangerous liquidity drain happening in the U.S.
Yeah.
What's the spark? What connects these two and finally sets off the revaluation Faber predicts?
Faber's theory links them through the ETFs, specifically SLV, the big silver ETF, because most of that ETF metal is supposedly in London vaults. What happens if SLV can't get enough physical silver to back its shares?
The price has to break away from the paper market.
Exactly. The price of SLV itself could detach from the silver futures price. The paper promise fails to match physical reality.
And the consequence of that disconnect?
It could trigger a crazy feedback loop. The SLV price spirals higher as the fund desperately tries to find metal. This forces London, the LBMA, everyone involved, to scramble for silver from anywhere, pay any price, just to try and regain control.
Like the end of 1979, early 1980.
The blow-off top.
That's the kind of dynamic he envisions, a positive feedback loop where the paper failure drives the physical price into the stratosphere.
But that's the market mechanism breaking. The real explosion needs the Fed, right?
Absolutely. The final massive explosion kicks off only when the Fed is cornered, when they have to pivot. Cut rates back to zero, restart QE on a scale we haven't seen before, just to stop a total credit meltdown.
And when that happens,
Faber believes silver goes limit up multiple days in a row, no dips, no corrections, just a straight line revaluation. It stops trading like a commodity and just reprices violently to reflect its true monetary value.
so we've just laid out two massive pressure points. London's physical silver market failing structurally, seen in the vaults and that plunging gold-silver ratio,
Yeah.
and the U.S. repo market literally running out of dollars, signaling systemic seizure.
And the core message from Rafi Faber's analysis. It's pretty stark. We are witnessing the pre-crisis turbulence right now. This tightening phase is necessary before the inevitable Fed pivot that triggers the final explosive repricing of real assets.
Which leaves you, the listener, with a critical question. Do you think the central banks can actually wrestle control back this time? Or are we really standing right on the edge of a massive reset where physical metal is the only thing that truly matters?
Faber warns, once that printing press gets turned back on full blast, there's really no going back historically. So if you want the analysis that helps you see these breaking points before everyone else does, you really need to subscribe to CredEdge. Hit that notification bell right now. You won't want to miss what comes next.